This is Money Guide with Mary Sterk from Sterk Financial Services. Now, here's Mary Sterk.
Welcome to Money Guide with Mary Sterk. I'm Mary Sterk, founding partner and CEO of Sterk Financial. And with me today, I have one of my partners and financial advisors, Jordan Ireland. Hi, Jordan.
How's it going today, Mary?
It is fabulous. And today we are here to talk about everybody's favorite thing in the world to talk about, taxes. Just kidding. Nobody really loves talking about taxes, but it is something that's very important for you to understand. So that's why we think it's important enough to do a podcast and radio show about. And so here we are today.
Yep. We just want to break down some of the most basic things and some of the most important things that will affect our clients on a day-to-day basis. So hopefully you'll get something from this and come away with some very valuable knowledge.
There you go. So there's been a lot of tax changes this last year, especially as a result of the One Big Beautiful Bill. And this bill is big for sure. There is a lot of pages to it. It requires a lot of careful digestion and understanding of, everything in it to apply it. So we're not going to try to go through the whole thing, but we are going to talk about some of the individual tax things that are a part of it so people understand what the changes are and also when they affect you. Because I think it's very interesting throughout the bill, Jordan, that things don't all take effect at the same time.
Mm-hmm. Right. And a lot of things too, there is just extensions for a few years. So a lot of things are made permanent from the previous Tax Cuts and Jobs Act, but some of the things that we have are only for a short period of time as well. So we want to make sure that we're taking actions to take advantage of some of these lower rates and deductions and things that people are going to get over the next few years.
Yes, exactly. Okay, so the very first thing that I want to say is just making sure everybody has a very basic understanding of how taxes work, because some people think that if you make this much money, then this is your tax rate on everything, and that's not the way that it is. So taxes are on a graduated system. The first part of money you make, you don't pay any taxes on. The next part of money you make, you pay some. The next part of money you make, you pay more. And the more money that you make, the next chunk of it just gets taxed at a higher and higher bracket. So that's how our federal tax system works now. So I think that one of the best parts, in my opinion, of the One Big Beautiful Bill was that the bill extended the tax cuts that we had in a prior law, which is the Tax Cuts and Jobs Act. So Jordan, tell us a little bit about what extending that actually did for people.
So this is one of the more permanent provisions of the bill. So until further legislation, because whatever we say, everything is permanent, but we all know that nothing is necessarily permanent. So basically, the tax rates that we've all been enjoying since 2017, those are going to be extended and those are going to keep going indefinitely until something else changes. So the majority of households are paying a lower income tax rate today than they were prior to 2017. So we get to keep enjoying that benefit. And like I said, we never know what's going to happen down the road, but right now we can all be pretty happy that our taxes are going to stay a little bit lower.
Yeah, one of the things that I liked about what they did inside of here was making some of these things permanent. So in the past, they've had dates that they say, hey, this is good until this date, and then it's going to sunset and go back to the way it was. By making some things permanent, it at least gives us an outlook of how to plan a little bit better or a little bit longer. Now, permanent really just means until the next administration has the power to change it. But at least for now, we have a track to run on, which I think is good for people when it comes to tax planning.
Yes, definitely.
Now, here's the deal. I believe in paying taxes, but I don't want anybody to pay $1 more in taxes than they have to. So that's why it's important to understand how these things affect you. So knowing the law is one thing, and knowing the tax brackets were extended is another thing. But one of the best benefits, I believe, of the extension of these tax cuts is the fact that it maintains the ability to do Roth conversions at a cheaper rate, a cheaper tax rate for people. So Jordan, share with people what a Roth conversion actually means.
Sure. So I think across the board, a lot of people, a lot of older folks maybe not, were not necessarily doing a lot of Roth contributions previously. It just wasn't as popular. So we're getting to a point now where a lot of people want to try and get that tax-free money into the retirement portfolio. So what you can do is you can take chunks of money out of your pre-tax money. So like 401ks and your IRAs have money that you got a tax deduction on previously. We can take money out of those accounts, pay taxes on them, of course, because we're not going to get away from that. But then we can roll it into a Roth IRA and allow that money to grow tax-free for the remainder of that growth period. So great opportunities there. We take a look at the timelines and everything because it's not right for everybody, but there's a lot of advantages to being able to move some of that money from a taxable bucket in retirement to a tax-free bucket in retirement.
So one of the things that we often get questions about is when's the right time to think about doing these Roth conversions? And the reality is there is kind of a bit of a sweet spot for some people. Now, it doesn't work for everybody, but just kind of think about it this way. Let's just say you retire when you're 65. And you don't have to start taking a required minimum distribution out of your IRA until you're 73. So you have this 8-year period in here where it's completely up to you how much you take out of an account that is going to have taxes due on it. So you might be able to structure your investment portfolio and your income streams in such a way that we can take some money out during that 8-year period and do the conversion to the Roth. That does increase your taxable income, but with these tax brackets staying lower, it just makes this more attractive. And to do it in the years where you don't have as big of a taxable income from other sources. So that sweet spot really is kind of from the time you retire until the time you have to start taking those required minimum distributions. Now, again, it's not for everybody. You need to visit with your CPA, visit with us about it, but it is something that can be a very effective strategy. And why? It's because Roth IRA money, if handled correctly and held for the right amount of time, is tax-free on the growth. And I don't know about you, Jordan, but tax-free is my favorite kind of money.
Yeah, yeah, absolutely.
Okay, so the next thing to kind of understand and know when it comes to planning your taxes is that there's this thing called a standard deduction. And this is something that has changed significantly over the past, say, 10 years. So it used to be the standard deduction was pretty small and that people, if they wanted to get deductions above that, had to do a bunch of itemizing for things. A few years back, they changed the rules on this. They made the standard deduction a lot bigger, and now people don't need to itemize as much. So you get a bigger deduction without all the fuss of itemizing, and it helped a lot of people really simplify the filing of their taxes. So Jordan, on the standard deduction for 2025, it is around 15,750 for single, and it's 31,500 for married filing jointly. So explain how the standard deduction interacts with the tax brackets.
Sure. So really what the standard deduction does is it's just taking a chunk out of your taxable income and kind of extending that first part of your income that you don't have to worry about paying taxes on. So it's just giving everybody an additional tax break. One of the awesome things that we're going to talk about with some of these additional deductions and tax breaks that we're going to talk a little bit more about on here is that these are above the line, which means you don't have to pick between itemizing and just going with your standard deduction. That was the case with a lot of deduction previously, is if you wanted to deduct anything, you were basically giving up your standard deduction. So a lot of these additional, kind of little tax gifts that we're going to be talking about are above the line, which means you got your standard deduction and then you can take these as well. So lots of opportunity in the next few years.
Yeah. So really paying attention to things over the next few years is critical because not all of them do last forever. So one of the things that I think is really kind of an interesting one, and it's been a hotly contested thing and in the news and things like that, has to do with the SALT tax. So Jordan, share with our listeners, what is this SALT thing?
Yep. So SALT is your state and local tax. So what we're saying here with the SALT deduction is that with the new law, the SALT deduction previously was 10,000. Okay. New law is going to take it all the way up to 40,000. But keep in mind, this is one of these limited time things. So this is only going to go from 2025 to 2029, unless, again, next administration extends it. So in 2030, it's going to revert back to the 10,000, which was part of the Tax Cuts and Jobs Act. So that's a huge increase for people. And basically what that does is it allows you to not get double taxed. If you're paying money on, taxes at the state and local level, maybe then we don't have to pay federal taxes on them as well. So they're capping it at 40,000 and it's going to phase out too. So if you're a high income earner between 5 and 600,000, that's where you're going to start to see that phase out. So, we can't have all of our cake and eat it too, but there's a lot of room for a lot of earners there, going all the way up to that 500,000 mark where you can experience a great deduction in some of those taxes that you're paying already.
Yeah, now there was a lot of provisions in the One Big Beautiful Bill that helped the higher net worth, higher earners, but the SALT deduction is something that helps pretty much everybody and actually doesn't help the higher earners because they're phased out on that. So this is the average income in America, people. This might help you. So whatever you've paid in your state and local taxes, you get to deduct now on your federal return during these years. So think about what we just said. If you're married and filing jointly, then you have a $31,500 standard deduction. But if your state and local taxes are $40,000 and you can write those off now, look how much that went up. Look how much more you have that you can now write off and not have to pay federal taxes on. So when Jordan calls them a little bit of a tax gift, I think that's a great way to say that.
Congratulations to Mary Sterk and the team at Sterk Financial for earning a spot on multiple Forbes lists for 8 years running, including the 2025 Forbes Best in State Wealth Advisors and 2025 Forbes Top Women Wealth Advisors Best in State.
There were a couple other tax gifts that I think are important for people to know and also know when they started. And these are also tax benefits for people that aren't making the higher incomes. These are not the tax benefits for the 1%. This is the tax benefits for the other 99%. So one of my favorite one is no tax on tips. I love that. I think that's great. I was a waitress once upon a time, and I think that's great.
Yeah. It's like that. This is very much one of those things that, you work hard to get that extra money. And this is a great way to get some of that taxable money out of there and just kind of have a little bit of a buffer between what you're making and the tax rates. So,
right. So the law says that you can have a deduction on up to $25,000 worth of qualified tips. And it has to be by a worker in an occupation that typically receives tips during a taxable year. It starts in 2025. So, hey, y'all, if you're getting tips this year, this deduction is for you. And I think that's fantastic. So there are phase outs for these as well. And so you can take a look at your own total income situation and figure out if this is actually going to apply to you. But, they did put some caveats in here, though. Like, they don't want to start having people all of a sudden start getting tips when they weren't before, and then using that as a write-off. So it has to be jobs where tipping is customary, like food service, bartenders, hairstylists, nail technicians, massage therapists, things like that. But that's a very nice boon for people to not have to pay tax on those.
Yeah. Also has to be cash tips. So if a very nice customer wants to tip you with a car, unfortunately, not going to work that way. So got to be cash, credit card tips, all of that good stuff.
Yeah, so it just can't be a physical object that's the tip, and then the value of that, it has to be monetary in value.
Right.
So,
Yep.
let's talk about no tax on overtime. Tell us about that law change, Jordan.
Awesome there too. Again, anytime we can add some money to and not have to pay taxes on it. So again, just like the tips, up to 25,000. And again, this is not permanent, 2025 to 2028. So take advantage. Just like the no tax on tips, it phases out over at 300,000 for a married couple. So even though it's not going to benefit the real high income earners, it does give you a lot of room. If you have a spouse that maybe has a little bit higher income, there's still a lot of room you can take these deductions. So just keep in mind with the overtime, it does have to kind of be itemized and specified on the W-2. So that's got to be on the employer to kind of mark that out where the overtime is so that they can see what is qualified overtime.
So if you're working a lot of overtime, let's say you're getting paid time and a half on something, the half part of that and the time and a half is really what's counting towards this number. However, when you get your W-2, there's a couple different boxes on there. There's a box that's going to show your wages, and then there's a separate box that's going to break out what the overtime was. So if you're somebody who typically gets a lot of overtime pay, and you want to take advantage of this tax deduction, I would be having a conversation with your company's HR department and making absolutely sure that they're set up to show that separation of regular wage and overtime on your W-2. If it's not separated on the W-2, you don't get the deduction. They're very clear about that being part of it. Okay, so another one that I think is kind of interesting is this no tax on automobile loans. That's fascinating. I kind of love this one.
Yes, very much so. And I think they really want to boost the demand for US made automobiles because that's a big thing here. They're giving us this tax incentive and they really want to drive that consumer demand for us to go American made. There's a big drive here for that.
So let me read the law and then we'll talk about it a little bit. The act gives us a temporary deduction. So again, it's not forever. Of up to $10,000 a year on interest paid on qualifying loans, beginning with any automobile purchases made in 2025 through 2028. So it does qualify in 2025 if you made that purchase. So you were talking earlier about these above the line and below the line deductions. This is an above the line one. So you don't even have to itemize to be able to claim this. This is on top of everything else.
Right.
So, okay, it's not all automobiles though. It's not everything. It has to be American made. So go America made vehicles. But it also has to be new. It's not for used cars. And it does not include ATVs or campers and trailers. So those are ineligible for it. It is actually just regular vehicles. So. Yes. But
the car has to be purchased between 2025 and 2028 too. So keep that in mind. If you have one already, if you had one that you purchased in 2024, unfortunately, that's not going to qualify. The purchase has to happen during these next few years.
Yeah, so just like what we said at the very beginning, there's a lot of complexity to these. There's so many nuances to each one of these different provisions inside of the bill. And so again, it's important for you to know enough to ask your tax preparer about this or your financial advisor about this, but everybody's situation is different. And so no blanket advice here, just saying, be aware of what these changes are and how they can potentially affect you.
Right.
Well, I think that this has been a great overview in terms of just a few of the big tax provisions that are at an individual tax filer's level. And I really hope that this has added some value for our listeners, thinking about what you might want to do, timing on when you might want to purchase things, conversations you should have with your advisors, and things like that. So we hope these tax tips have been valuable, and we thank you for listening to Money Guide with Mary Sterk.
Sterk Financial Services celebrated 20 years in 2024. The views expressed are not necessarily the opinion of your audio provider and should not be construed directly or indirectly as an offer to buy or sell any securities or services mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can ensure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should only be relied upon when coordinated with individual professional advice. Securities and investment advisory services offered through Osaic Wealth, Inc., member FINRA SIPC. Insurance offered through Sterk Financial Services, which is not affiliated with Osaic Wealth. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth. The rankings for the Forbes Best in State Wealth Advisors list by Shook Research is based on due diligence meetings to evaluate each advisor qualitatively, a major component of a ranking algorithm that includes client retention, industry experience, review of compliance records, firm nominations, and quantitative criteria, including assets under management and review generated for their firms. The Forbes ranking of America's top women wealth advisors is based on an algorithm of qualitative and quantitative data, rating thousands of wealth advisors with a minimum of 7 years of experience and weighing factors like revenue trends, assets under management, compliance records, industry experience, and best practices learned through telephone and in-person interviews. There is no fee in exchange for rankings. Forbes is a trademark of Forbes Media LLC. All rights reserved. Rankings and recognition from Forbes, Shook Research are no guarantee of future investment success and do not ensure that a current or prospective client will experience a higher level of performance results, and such rankings should not be construed as an endorsement of the advisor.